Hello, over the next 7 minutes, we will make you feel like a VVIP. But it doesn't stand for very, very important person. Well, it can do. You'll find out more in just a few moments. We have a VVIP here with us. He is Steve Brice, Chief Investment Strategist from Standard Chartered. And you're here to bridge that gap, Steve, between your immense knowledge and experience in the market and for people who have possibly never invested before. So first of all, can you give us your take? Can you say some soothing words about what we might read in the headlines about Greece and Europe generally and the United States first?
Yeah, I suppose we really see the overall environment as being a muddle-through environment. So the economies aren't going to be doing too great, but we don't expect a recession either.
Really?
So we're expecting sort of growth of around 2%. So it's really not as strong as you'd expect pre the global financial crisis, but levels that are still relatively stable and fairly consistent. As we see growth weaken, we'd expect authorities to come in and stimulate particularly monetary policy, so cut interest rates, put more money into the system. And that should alleviate much of the downside risks.
I say really because, for a while it felt really, really bad. It almost felt like back in 2008 when Lehman's went down.
Yeah, and certainly Europe has the opportunity to sort of be another Lehman event if they so decide. But the reality is that we'd expect policymakers to come out and every time there's a market crisis or whatever, to come and make some major advancements in terms of unifying the single currency in true form. So we believe that the European crisis is very solvable, but what is getting in the way at the moment is politics. And we believe that it takes market crises to then bring them back to the table and then solve that immediate crisis and move, as I say, towards more integration further forward.
Mm-hmm. Now, you hinted at it just now. You said to really do the reforms, to really fix the problem. What, in your view, is the medicine that they need to take?
Well, I think they really need to do three things. They really need to fix the banking sector. They need to have more pro-growth policies, and they really need to sort of bail out the governments that are in real trouble, or actually allow them to leave. One of the two. The second result actually might be better for markets ultimately, but that's the biggest fear. If you see a country such as Greece going, which is very, very small, of course, we shouldn't, in a global context, shouldn't really be too worried about Greece, but the worry is that would open the doors to then other countries leaving. Our view is that would actually lead to a massive policy response and therefore defining exactly what the euro is going to look like in the near future and over the next 5 to 10 years. And we believe that would be very positive as it removes uncertainty from the global outlook.
And in the meantime, we can't leave the money under the mattress unless, of course, you really have that much of it that the bank doesn't want it anymore. What sort of investment strategy should you then take on?
Well, as you mentioned in the introduction, we've got a VVIP strategy. So V stands for value. We believe people should search for value. We believe that market weakness, as we're seeing at the moment, is creating huge value in different asset classes. So that's one thing that investors should be looking for. Value
means cheap?
Yes, so buying things that are undervalued, that are cheap relative to history, relative to other asset classes as well. We believe, like for instance, global equities is in that area. We believe they're cheap versus history and versus other asset classes. Mm-hmm. Second point is we do expect it to be volatile, so you need to be prepared for volatility in market prices, in market action. We're going to get negative news from time to time. We're going to get positive news from time to time. That's going to create volatility. So diversified portfolios is obviously one way to manage that volatility, choosing assets that don't move in the same direction all the time. So you sort of smooth the fluctuation in terms of your portfolio. But also be prepared for that volatility and saying, OK, I've got some cash on the sidelines. When markets weaken, that's a good time to invest. Mm-hmm. The I is for inflation. So we don't believe in deflation, we believe in inflation. So prices of things that people buy we expect to go up over time. Given interest rates are very low, in Singapore obviously around 0% interest rates. Yes. So investing excessively in cash, having a lot of cash on the sidelines is not necessarily the best way to approach the investment environment.
So leaving it under the mattress really is a very bad option, isn't it?
We do believe so. So we're not looking for massive inflation, so we're not looking for 10% inflation, but Singapore has been getting used to 5% inflation. You have cash, that means your purchasing power of that cash is going down 5% a year. That's not really a great outcome for any investor.
No, you actually need to make 5% in the markets just to keep pace.
Yeah, and that, I suppose that keeps in theme for the P, which is be paid. We like assets that generally pay you to own them. So one area would be, we talk about equities, okay, so if you look at equity markets around Asia, giving you 3 to 4% dividend yield, but if you can actually select higher dividend equities, then you can get up to 4, 5, maybe even 6% yield. And also in the bond space, you can also choose corporate bonds that give you a higher yield than, for instance, US Treasuries. So overall, VVIP is where we frame it.
Mm-hmm. Value, volatility, inflation, and be paid. But then how do you actually implement that? Let's say, okay, Steve, that's all well and good. We know the strategy. What are the tactics?
So I suppose what we'd say is, okay, let's take a holistic opinion of how risky you want to be with your investment. So, and you have obviously very conservative investors that would generally be more in cash, which is actually risky in real terms, but in nominal terms you should protect your wealth there. And in things such as government bonds, so Singapore government bonds or US Treasuries would be another example, all the way to a more aggressive investor that would be much more skewed towards equity markets and high-yield bonds, for instance. So basically the starting point is to say, okay, where am I on that spectrum? And then go to an advisor that can sort of say, okay, given that's where you are, this is the sort of portfolio that we would build for you. This is what the asset classes we prefer at the moment. And really don't jump in all at once. I mean, if you haven't invested before, I would suggest you build something slowly over time to take advantage of the volatility that we're seeing coming through. But look, have that end objective saying this is what my portfolio should look like in the next 6 to 12 months.
Finally, Steve, you've been in the markets for a long time, in many countries too. If you cast your mind back to when you first got started, what do you think was the 1 or 2 key learnings, maybe an error that you made or an early piece of wisdom that you picked up that could help people who've never invested before?
I think the key thing is to think about your objectives. Actually, what I talk about the macro environment. I talk about, we like this asset class, we like that asset class. But I think actually more important is what are your objectives? If I say I really like global equities, which is one of our top asset classes at the moment, yes, probably almost every investor should have some money in equities, but far more important is saying, okay, my risk profile is this, and therefore I should have only 20% in the global equities, or if I'm more risky, then I can have 50%. But it's really, really saying, I need to understand what I'm trying to achieve before I then decide how I'm going to invest.
Thanks so much for coming in today. Great to have you with us.
Thank you.
Steve Brice, Chief Investment Strategist at Standard Chartered. Singapore Investment Week is on from the 25th to the 31st of August. The link on your screen will give you more information on seminars and happenings during that week. I'm Mark Lowdy. Thanks for watching.